Hello, everyone. Today on the final bar, my guest is Todd Campbell from EB Capital Markets based in Boston. We're going to help us hopefully make sense of this market environment as we get ready to turn the cameras on and light things up. The market really distributing into the close. You're up sharply one day, you're down sharply the next day. And that sort of volatility, that sort of movement feels about right to where we're at, where the market looks incredibly positive, incredibly negative based on the short-term movement. So we're going to focus on some of the long-term takeaways in today's show. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close, break down the market's activity, look at things through a technical lens, behavioral lens, and connect what we're seeing today versus the big picture, try to make sense of things. And as I mentioned in the introduction, market really positioned yesterday in a position of strength, really rallied into the close. A lot of stocks breaking above short-term peaks. The S&P breaking above its most recent swing high starts to feel like this big validation of the bullish thesis. Then today, rumors change. The sentiment shifts going into the close, and the market finishes down with the S&P down over 1%. So we're going to talk about this situation. In this bear market rally thesis we've been talking about for a while. The S&P is undeniably in this big resistance area leading up to the 200-day moving average. We'll try to pick out some of the themes that may have become a little more clear today. Coming up on the final bar and elsewhere on StockCharts, we have some fantastic guests to try to help us make sense of what we're seeing. Today, as I mentioned, Todd Campbell from EB Capital Markets. Tomorrow, we have Doug Bush joining us from ChartSmarter in New York. On Thursday, we have Kim Sokoloff joining us from the New York area as well. Next Monday, Memorial Day, so we're going to take the day off for this show. We're actually going to be showing a replay of a series of segments we did called A Pilot's Guide to the Markets, talking about applying the lessons of aviation to the investment process. Also, our next episode of Behind the Charts is coming up on Monday the 25th, and it's Joe Duarte from Joe Duarte in the moneyoptions.com. He's an anesthesiologist that got into investing later in his career, and it's a fascinating story hearing about how he picked up the technical toolkit and the tools of the market analyst. I want to get right into our market recap here. As we're looking, I mentioned the picture was so different about 30 minutes ago, 45 minutes ago, and things fluctuated dramatically. We were flat for the day around 3:15 Eastern until things really rolled over going into the close. The S&P down to 29.23, just under that, with the NASDAQ finishing down a little less than that. Technology, one of the bigger, better sectors today. So that's what's sort of holding those up a little bit. Mid caps down 1.25, small caps down even more, over 2%. So sort of a reverse of what we saw yesterday with a big up move with a lot of small cap, mid cap leadership. Now, to be honest with you, I mean, if you talk to anyone who's been in the markets and you saw what happened yesterday, the big gap up, the big move higher, all that accumulation, given the economic environment, given the conditions we're in, most people would tell you we need sort of a recovery day after that. We need a rebound of sorts just to digest it. The way that this played out with the acceleration going into the close is certainly not how I would have expected. I'd expect a little more of a gradual move. So this is certainly more, a shift in sentiment going into the latter part of the day. The VIX up above 30 now, around 30.65 for now. So what does this do to the daily chart of the S&P 500? So, this illustration that I put in yesterday, and I tell you, when I put out the show on YouTube last night, and I mentioned the bear bull flag measures to S&P 3600, I got not a small number of pushback sort of comments and questions related to what I was saying. Again, my goal with this is not to necessarily predict what's going to happen next. It's to apply the technical toolkit and point out what I'm seeing. And what I saw yesterday was, based on this pattern, the big move higher, this parallel correction pulling back, we broke above the upper bound, but if you listen to what I said, the key was confirmation. So when you get a breakout like that, it's all about the confirmation. It's all about the follow through, because you'll have a lot of false breakouts in any sort of analysis of charts. And I would say today we did not get that upside follow through that would really validate that super bullish sort of signal. And again, to be clear, we've talked about this range that we're in, that 2935, 2950 up to 3000, which is Fibonacci levels. It's the 200-day moving average. I think we're in that range. I don't see us getting significantly higher than that before we retrace a little more. And so, certainly I think overall the weight of the evidence still remains in the bear market rally thesis. Interesting to note, again, with all the movements with the gap up higher, the RSI for the S&P 500 still has not gotten above 60. That's pretty classic for a bear market phase. So I think that's still sort of in play here. Looking at the dashboard and seeing what else happens, looking at some other markets. So bonds finishing higher. A lot of that came in the last hour. Both stocks and bonds were sort of flat around 3 p.m., 3:15, and then stocks sold off. Bonds accelerated to the upside. So the TLT finishing up just over 1/3%. On the commodity space, you had gold up about 1%. That was the one of the bigger gainers if you look across the board. And the GLD, the long-term short of the GLD, we've referred to it a number of times, just in this classic bullish trend. So when you think about where you're allocated, you think about that commodity portion, gold, if it hasn't earned it by now, it certainly earns it at the very least, probably some consideration, thinking about how that should be part of your your thinking as you look across assets, and think about the momentum picture. Think about what's actually working. When we look at the sector distribution, you saw comm services was flat for the day, and again, this is processing a lot of things good with things selling off pretty dramatically into the close, about where things laid out. Communication services, number one, consumer discretionary technology. So still that sort of traditional offense finishing at the top of the list. Just a lot of things sort of distributed, was up more earlier in the day. Energy, the big loser today, followed by financials, followed by real estate, consumer staples. So REITs were up pretty big. A lot of those things yesterday related to retail and things like that, all sort of coming back to earth today. In terms of industry groups that actually work together today, so within energy, actually one group that was up over 2%, renewable energy equipment, and then gold miners, number two. Newmont Mining's been a consistent, top 3 name, and it's number 3 in our scooter rankings today, which is notable. Mining also up there as well. But you also have some groups within consumer discretionary: toys, durable household products, home construction. That's the home builder space, broadline retailers, all within the top 10, and again, all positive for the day as the S&P closed down pretty significantly going into the close. So there were certainly pockets of positive movement, even though the sectors were all down. There were groups that certainly rallied pretty well. In terms of a summary, I just want to wrap up with a couple of quick comments, and then we're going to get shortly to my guest, Todd Campbell. I did want to point out, some people had asked about Dexcom, DXCM, because we've been rotating this number 1 ranking in the scooter rankings. Things like Regeneron's been up there, Newmont Mining, NVIDIA recently sort of popped up here. Netflix has been in the top 10, sort of this consistent group of names. And out of nowhere, it seems like this stock comes up. So this one was just promoted from our mid-cap space up to a large-cap space, because the company got big enough that it actually earned right in there. So it might be a name that you're not as familiar with, but the trend has certainly been impressive. If you look at the relative gains on this stock over the last year, on a relative basis, up over 200% relative to the S&P 500. This is within the healthcare sector. It's a medical supply company, and so it's now our number 1 ranked stock based on our sort of traditional trend following toolkit. What's interesting about DXCM as a number 1 stock, you're starting to get this bearish divergence, or at the very least coming out of the overbought region. So it's had such a run, really propelled. I mean, it went from 100% to 200% plus over the S&P 500 just in the last 6 weeks, and that's pushed it to a pretty high extreme. Now, in an extended uptrend, stocks like this can become overbought and remain overbought, or pull back and not get too oversold. And so that's, I think, with something like this, that's what you can generally sort of expect, at the very least, a pullback. The question is, what happens on that pullback? Do we remain above key moving averages? Where does the RSI kind of come off to? What is the relative strength to? And that tells you what sort of trend to potentially consider going forward. So that's the answer of what happened with that stock, how it sort of came into being on the list. It's one that I think many are not as familiar with. And then lastly, I just want to finish off looking at very quickly some of the quick breadth readings. This is one of the ones that to update you, looking at the advanced decline lines on the different market caps, from large cap to mid to small. As you know, if you've been following the show, we highlighted the fact that these all broke down. This is as the market sort of tapering off here in this sideways trend. You get them all rolling over. They rallied through yesterday. These are not updated yet through today's close, but through yesterday they rallied on this little potential breakout here. But if you look, they're all still. I think that signal is still in play, where you sort of have this this short-term uptrend from the March lows that now we've put in a lower high. Now we've put in a lower low, and until that changes, until we get a higher high and a higher low, the tactical trend, according to this breadth reading, is more negative than positive. And again, that's even with the bounce yesterday, still, did not achieve a higher high. It's still sort of in a wait and see mode. It was actually interesting to note, I look at so many charts on using the highs and the lows. If you just look on a closing basis, from the close at the top in February, the close at the low in March, we actually haven't quite broken above that 61.8% retracement level yet on the S&P 500 on a closing basis. It's right around 2950 there, just below that. And so again, until we get a close above there, and again, more importantly, a close above the 200-day moving average, I still think it feels more like the end of a bear market rally and not the next leg of a huge uptrend from here. But I have been wrong before. It could happen again. We're going to take a quick commercial break. That's our recap for today. Back with my guest, Todd Campbell from EB Capital Markets. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller at StockCharts.com. As a reminder, we're going to do a mailbag segment a little later in the show. You can always send your questions to us anytime via email, thefinalbar@StockCharts.com, or on Twitter, just look us up at FinalBarSCTV. We'd love to answer your questions in a future mailbag segment. I want to bring on my guest, Todd Campbell from EB Capital Markets in Boston. I've known Todd for a number of years, followed his work when I was on the institutional buy side there. And Todd, it's good to reconnect with you and good to have you on the show today.
Dave, thanks a lot for having me. This is going to be a fun conversation. I'm really looking forward to it.
So I feel like our cup runneth over with things to talk about, with everything that's happening. And obviously we've had, in 48 hours, we've had everything's perfect and now everything's bad again going into the close. You sent a couple charts just focusing on some of the breadth readings recently. First chart, what is this telling you?
All right, so I actually think that this risk on, risk off market we've seen day to day is actually the perfect backdrop for this first chart. What we're looking at here is something that we do for our subscribers at EB Capital. We do it every week. It's most useful at inflection points. And what it allows you to do is kind of take a big picture view and eliminate maybe the emotion that could be really harmful to portfolios if you're paying too much attention, I guess, to the day-to-day machinations, risk on, risk off, risk on, risk off, risk on, risk off. And what it does is it takes a look at the 1,500 or so stocks that we follow in our research, and it shows you as a percentage how many of them are trading at or more than 5% above their 200-day moving average, that's the blue line, or greater than or equal to 5% below the 200-day moving average, and that's the red line. And where I find this really, really helpful to my process is trying to figure out from a macro perspective, does it make more sense to be taking a little bit off and raising a little bit of dry powder, or putting some money to work? I mean, when you get a very high level of stocks that are trading greater than 5% above their 200-day moving average, typically that's coincident with overbought. And as you know, you can remain overbought for a while, but it does give you a perspective of saying, well, maybe I shouldn't be pushing here. Maybe I should raise a little bit of money, like back in January when we had a very high elevated reading. And then, the alternative, when you get a very low reading like we did in March, I think late March, we got down to about only 2% of the universe trading greater than 5% above the 200-day moving average. That's telling you, you know what? The odds are in my favor. I can commit my cash now.
Now, interestingly, the second chart is actually zooming into the more recent picture. So what is this telling you right now?
All right, so if you look back at that 2018 data, you see that obviously we got very similar levels here in March that we did back in the 2018, and we got that nice rally off of it. When you get into an established trend, this is not as useful because you can bounce around a lot. So I typically really only focus on it when I get to those points where I'm not really sure what to do, and I want to see whether or not we are at an inflection. Where I'm looking at this chart right now, and this is the way I'm playing it in my own personal portfolio and for clients. If we got up above 30%, then I would start to back off a little bit. And if we got up to 40%, then I would definitely be raising cash. So right now, the trend is still your friend, if you will. It suggests to me that you are a buyer of weakness. So who knows if we get that rollover and the retest or not.
Mm-hmm.
But this would be telling you that if we do trade lower, you should continue to use it as an opportunity to buy and not as an opportunity to sell. Very much different than when we were looking at January.
Got it. So correct me if I'm wrong, but this is essentially looking at breadth in the form of stocks that are sort of overextended, sort of farther away from their 200-day moving average and sort of looking for that, I guess, that mean reversion opportunity, right? Where it would sort of whip back after that, right?
Right. One of the things when I designed my research, one of the things I was concerned about was all the false positives you'd get when stocks jumped above the 200-day or fell below the 200-day. So what I found most useful was just to put these 5% bands on either side of the 200-day moving average and consider that 5%, that 10% area no man's land.
Right.
We're telling you a heck of a lot.
That's a great way to think of it. Actually, I love the approach there. Now, one of the many things I think most investors are struggling with is an apparent disconnect between what we're seeing with the markets and what we're seeing with the economy. Right? Is this a quick recovery? Everything's fine. Stocks are going up. FANG stocks are leadership all over again. Or is this the end of the world? It's going to take forever. And you shared a couple charts just looking at some of the data behind, what's fueling, I think, investors' decisions, or at the very least, consumers' decisions. First off, we're looking at unemployment. Help paint this picture for us.
Well, one of the things that I always get asked about the virtual water cooler now from some of the people maybe who weren't investing in the markets back in the 2000s like you and I, was how is it possible that the market's making such a big move higher when we're nowhere near seeing the worst economically? Unemployment is still climbing. GDP is forecast to fall. I think the CBO came out at 3% today. It's had 38% in the second quarter. So how is it possible? So I wanted to share this chart because it helps you see that if you go back to 2001 and 2002 recession, and you look at where the NASDAQ was and where that bottom was, you can see that the bottom occurred far below the peak in unemployment, total unemployment. So this is not abnormal to see a market put in a low before you get the worst news, right? Market's a discounting mechanism. It's looking forward. In 2008 and 2009, you can see that's a similar. If you go look at that March 2009 time period, it wasn't until about 6 or 8 months later that we actually saw the peak in unemployment. So while unemployment numbers that are this high, obviously grabbing everybody's attention, I wouldn't use that as something to say, well, I don't understand why the market is rallying because of unemployment. I just don't think that that's a helpful indicator.
It's so funny, and I think my takeaway from as you're talking is we so often confuse the relationship between stocks, the markets, and the economy. A lot of people look at economic data as a way to anticipate what the markets are going to do, and what you're showing is it's literally the opposite, right? If you want to get a read on the economic conditions, look at the market, because that's the better leading indicator of the two, right?
Exactly.
This is such a great take, Todd. We're out of time. I want to thank you so much for coming on the show today. Really appreciate your perspective, especially that breadth read at the beginning. Hope you stay safe, and love to have you back on again down the road. All right.
Absolutely, Dave. Thank you very much.
This is Todd Campbell from EB Capital. So it's such a great take. And again, what I love, from following Todd's work over a long period of time, just you got a little snippet of what I've learned from him, but he has a very disciplined process. He's built models on things like the breadth reads that he showed you, built on trend following, built on momentum, which speaks to, my background as an analyst. It's what I've always found to be really valuable, but also is able to relate it to other things, sort of those other inputs that I think are so important for a proper holistic investment process. So some really good takes there by from Todd Campbell. Want to move on to our next segment, which is answering your questions from the Final Bar Mailbag. So as a reminder, you can get your questions to us anytime, thefinalbar@stockcharts.com. All the questions I'm going to share with you now have come from you in the last 24 to 48 hours. So thank you all so much for sending in your questions. Let's get to it. Question number one, is there an expiration date on divergences when they occur, or any way to determine when they might correct? That's a really good question. And to be honest with you, no. The short answer is no. I don't think there's a time factor involved with that. And when we think of divergences, the chart of the S&P is probably what comes to mind the most. So you have this bearish divergence in February with higher highs in price with lower peaks in the RSI. As the market went down February to March, you had lower lows in price and you had higher lows in the RSI. And so, again, those divergences are key for indicating when the momentum is starting to taper off at the end, and it tends to happen at the end of a bullish phase or at the end of a bearish phase. And to be honest with you, more often than not, I found that they tend to work much more consistently on market tops, because markets tend to roll over. You tend to have that last gasp higher with less momentum. And if you look back over a lot of charts, you will see that situation like last August or last July in the S&P, similar sort of pattern, right? Higher peaks in price, lower peaks in RSI. But your question is, when do how long are these done? And so, for me, I think it's less about time and it's more about price. It's more about the price does afterwards. So once you see a potential divergence, at this moment, and if you cover up the chart and you start it here, if you rewind mentally to mid-February, it did not feel like things were diverging, right? The S&P continuing to go to new highs, a lot of stocks continuing to go to new highs. Things felt fantastic if you look at the average trend out there. So this momentum, this decreasing momentum was actually pretty difficult to believe. So what a lot of people would wait for is some sort of validation. Some would say maybe you need to break the swing low between those two divergences as some sort of follow through. Maybe the RSI needs to go below the swing low between the two highs that you're connecting. So an RSI going below 40 in this case, which sort of happened that last week in February, tells you, yep, it's validated, the price is reversed. The same thing down here. That's one way to do it. What I tended to look for is that subsequent high or low. So once we had the divergence, the market sold off. For me, I'm looking at the next peak. And when it was clearly a lower high, we've now made a lower low, we've now made a lower high, the trend is negative until that reverses. Here we finally had a higher high, we had a higher low first week in April. That suggests to you that the downtrend is over. And that idea, that simple process of looking at the peaks and valleys in price, I found a lot of times will keep you true with what the actual trend is and less on wishful thinking of how something will evolve. So with divergences, no on time, yes on price. And I think a lot of times that's really important because there can be false divergences that you will find if you look at enough examples. Question number two, what's your process when you observe bearish and bullish engulfing patterns? I noticed last week several names in the XLF space with some bullish engulfing patterns, and you're so right. We highlighted some of those. Wells Fargo is the one that just immediately comes to mind. And bullish engulfing patterns are easy enough to see on bar charts, but if you switch to a candle chart, it almost jumps off the page at you, and that's this pattern down here. So a big down body, a big up body, or a clear body. So that's a down close followed by an up close. In the second day's open to close range, the real body, as you call it, engulfs the first day's real body, and that's why it's called a bullish engulfing pattern. Your question was, how do you interpret that? So what you have to remember, a couple of things. This is from working with Steve Nissen years ago, talking with him about candlestick analysis. He's credited as the man who brought candlestick analysis from Japan, from the east to the west, really, and popularized it here. Many others have taken that up and have pushed it even more forward, probably. But I had great conversations with Steve, and he always pointed out, remember a couple of things. Number one, engulfing patterns, any sort of candle patterns are very short-term in nature. So it's really telling you about the next couple bars. I don't think necessarily the fact that there's a bullish engulfing pattern tells you Wells Fargo is going to round trip to 52 or something. Far from it. All that tells you is in the short term, demand outweighs supply and there's bullish sentiment. Traders are pushing this higher so much that it's engulfed and gone above the previous day's open to close range. So it's short-term bullish. It tells you about the next couple bars, and the general exit strategy, the way that you determine that that pattern did not work, is the low of the 2-bar strategy. So with something like Wells Fargo, you break below the low of around 22, that would invalidate that engulfing pattern. If you're not familiar with anything that I just said, that's okay. I learned candlestick analysis at the very beginning from books by John Murphy, the classic text, and also books by Steve Nissen on candlestick analysis. Our chart school actually has some really good explanations and descriptions of those as well. Last one I want to show you, let's see. Moving averages. All right. I was looking at my weekend review. I'm using the 21-day, the 50-day, and the 200-day simple moving averages on my chart review. Should I be using something different like the exponential moving averages? It's such a great question, and I'm sharing with you the fact that I've had extended, heated, and for the most part, fairly respectable debates with my boss here at StockCharts, Chip Anderson. He is very into exponential moving averages, and will explain to you exactly why. He's a former engineer and will tell you exactly why they are a much better measure of trend. I tend to go with I want to use what I know everyone else is using, and I've met so many investors that use the 50 and 200-day simple moving averages. So if I can look at what they're looking when they're making a decision, I feel good about that. So the way that I reconcile your question is I look at a little of both. My average daily chart, if I just want to know what key levels are important, what key breaks people are going to know, I think the 50-day and 200-day moving averages make most sense, because there are disciplines like the William O'Neill methodology, Investors Business Daily, and How to Make Money in Stocks. He talks about pullbacks to the 50-day or the 10-week moving average, simple moving average. The 200-day, I know so many institutional investors that follow that level and pay attention to it. So it's something you want to be familiar with. But for my longer term models, for my market trend model that is a systematic way of understanding trends, it's based on weekly exponential averages, the 21 and 34 week, and then the 12 and 26 week exponential moving averages. I've talked about this model a number of times. I've had a lot of questions on it. So at some point soon, I will make some time and write an article on my blog, The Mindful Investor, on StockCharts, and explain why I have those components and how I use it. So my answer to your question is, I think you're doing well by paying attention to some of the simple moving averages that other investors pay attention to. I like that idea, but I also like the value of using exponential averages as more of a trend following tool. So if I was designing a trend following system, a mechanical system of some sort, I would be using exponential averages probably most of the time. Thanks so much for those questions. Those are all questions from you guys in the last couple days. Keep them coming. We'd love to answer one of your questions on Friday's show. And we need to wrap the show by going right to the three charts in 3 minutes. Chart number one, consumer discretionary versus consumer staples. I think it's worth pointing this out because the cap weighted ratio, the XLY versus the XLP, has gone above the February high, which is pretty meaningful. Now, this is cap weighted, so Amazon has a huge weight in the numerator here. But having said that, a lot of staple stocks selling off, and obviously a lot of discretionary. It's not just Amazon, it's a lot of other things as well, rotating higher, and this has pushed this ratio above its February peak. Worth noting that the equal weighted version is nowhere near that, and that's because, of course, you're taking the Amazon overweight out of that, and it's more of an equal weighted version of the average consumer discretionary versus consumer staples, or the breadth of those sectors. But overall, the cap weighted one has certainly broken higher. I would love to see the equal weighted version confirm that by starting to break higher as well, to feel a little better about sort of a risk on environment going forward. Chart number two is technology. I feel like I've mentioned this a number of times, but it just keeps coming up, this consistent outperformance of technology in the form of the XLK. Potentially broke out yesterday, made a new closing high for the bull trend, but came back today with the sell-off of everything else going into the close. So I think the rest of this week's going to be really, really key to see if we get that follow through. We see get upside and approach the 200-day on things like the S&P 500 or roll over. And I think a chart of the XLK is going to be a great way to understand that. And my final chart of the 3 and 3 is just a cautionary tale with airlines. I saw a lot of people getting excited about airlines being up so much yesterday, huge gap up. But what I would remind you is always take a step back, look at the long-term charts and see where these things have come from. This group, the XAL, is still approaching a declining 50-day moving average from below, rolled over again today. So even though there's a big percent move one day, don't draw too many long-term conclusions from that. Folks, that's our show. Thanks so much for joining us every weekday for the final bar. Thanks to my guest, Todd Campbell from EB Capital. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.